Hey, party people, welcome to this week's Money News in Human Words, where I'm unpacking the headlines and what they actually mean for your money and, importantly, your investments. Now, the first piece I wanted to cover from last week was around US interest rates increasing and inflation over there. It feels like inflation is all we've been talking about for a while, but yeah, it is still playing out, and the US have just increased interest rates by 0.75% for the fourth time in a row. This is off the back of their inflation data that was released around a week ago that showed headline inflation increasing by 0.4% in September and up 8.2% over the year. That was up from the forecast of 0.2%. So basically coming in at double the forecast rate over a 1 month period. Pretty significant and still rising. So the fact that they've increased interest rates so much has not caused, well, it's caused inflation to slow, but inflation is still on the up, which is clearly an issue. That beyond the headline data, we can see that actually the core consumer price index, which is a measure of inflation which excludes food and energy, increased by 0.6% for a second month, bringing that annual figure to 6.6%, which was up from the forecast of 0.4%. So basically 50% higher than expected. And that core consumer price index is a really important measure that is supposed to strip away some of the more impactful noise to give a more true reading of inflation. So the fact that it's running at 6.6% is pretty crazy. Now, as a result, the share markets tanked and bond yields in the US dollar skyrocketed, although Wall Street then did a bit of a recovery with the market rallying. But the 10-year bond, so Treasury bond, so the government bond in the US, has increased through 4% to 4.05% before the data came out, which means that for investors, that cash is becoming actually an option that's not ridiculous. We've been through this period where cash rates are so close to zero. I was just reading on the weekend as well that like Berkshire Hathaway is now making like billions of dollars from cash yields because the cash rates are up, which is good from an investor perspective. What happened though, as a result of this inflation data, is that the Federal Reserve they increased the interest rate over there to by 0.75% to 4% at the November meeting. And some of the comments from the Fed chairman, Jerome Powell, have got markets a little bit concerned. He has said that the interest rate tightening might need to be higher than first expected, even though it was expected to be pretty high. So that in itself is concerning. And mention that he is, though, feeling that they are getting closer to being prepared to slow the pace of tightening of monetary policy. In fact, what he's saying is that they're potentially going to slow down the increases to interest rates. Now, this is the fourth consecutive 0.75% increase over in the US. Now, we feel like we've had it pretty tough in Australia with the tightening being the fastest pace since 1994, but over there, basically up 3% in just a 4-month period, which is a pretty staggering increase. He has said, Jerome Powell, the Federal Reserve chairman, has come out saying that he feels that the path to avoiding a recession has narrowed over there. So you can sort of read in between those words to say that he's thinking it's less likely that they're going to be able to avoid a recession in the US. But he did say that he felt that the slowing of the interest rate increases might happen either at the next meeting or the one after that. He said that he felt that it would be premature to think about pausing their rates while inflation is still increasing, and meaning that interest rates might end up being higher than expected. Said that they've got a ways to go, in his words, and yeah, the incoming data suggests that the ultimate level of interest rates might be higher than expected. Now, he did say in some good news for markets that he thought that there probably was something in doing too little rather than doing too much. So what he's saying there is that he'd probably prefer to ease on the side of less of a tightening of interest rates, because that's going to be better for the economy overall than doing too much and sending the economy into more of a grinding halt. Looking at the data, they've still got record low unemployment over in the US, sitting at 3.5%. Wage growth, though, is increasing 5.2%. So it's still reasonably high. And that then ties into inflation, because wages are increasing. It means that people are more able to spend more money. So look, it's a narrow path. Ultimately, it seems like there's quite a lot of trouble over there. We would, as investors in Australia and global investors, you'd prefer that the US is avoiding a recession, because that's going to mean better things for global markets. But clearly, they're committed to getting this inflation under control, and so there is still some work to be done there. In related news, on Friday, the Aussie dollar was up 2.9%. Now, I mentioned a few weeks back on the podcast that given that the Aussie dollar was at this all-time historical low, that the investments that benefit from the Aussie dollar strengthening against the US will be doing particularly well. On Friday, we saw the dollar jump from 62 to 65 cents. Now, that does seem a little bit strange, because given that the US interest rates have increased by 0.75%, while our interest rates have increased by 0.25%, normally what happens is that when a country has higher interest rates, particularly a country like the US that's known as a federal, like a global reserve currency, that more money tends to flock to the areas where there's a higher rates, because investors want to take advantage of those higher interest rates. But the opposite has actually happened there. So it seems a little bit strange. What that says to me, and obviously there's a lot of different factors at play here, but what that says to me is that markets think that the Australian economy will recover faster, meaning that Australia is a good place to be holding cash. And while there has been a jump up at this 65-cent level, it means that the dollar is still at a low. So there is still some good opportunity there when it comes to investing. Changing gears a little bit, I was reading this really interesting piece in the AFR over the weekend on how to pick the property market bottom. They talked about the fact that property prices around Australia have dropped 6% from a predicted 20% property plunge, that there could still be some way to go. And the fact that we've got a lot of investors sort of sitting on the sideline wanting to take advantage of the property market, but trying to get a bit tricky with their timing there to take maximum advantage of the conditions that are going. An opportunistic one there. Now, we saw that auction clearance rates have slid more than 40% on last year, and obviously the prices have come down. Economists are predicting that interest rates could peak in the first quarter of next year and begin to fall through 2023, which is a sign that the property market is reaching some level of stability. Now, capitals in Australia are down 6.5%, regional cities down 5% from data from CoreLogic, which monitors all of the transactions that are happening on property markets. But the economists, leading economists around the country, are predicting that property prices will eventually fall somewhere between 15 and more than 20%. So we've seen in Sydney that prices have slipped 10%, or 118,000 on the median house price, which is losing, still down less than half of the gains that were seen through COVID, through the COVID cycle peak in January. But it's not impacting all areas the same. Melbourne property prices 6%, Brisbane down 6%, Adelaide down 0.6%, so only $4,000 on the median house price. Darwin and Perth still less than 1%. So taking some time for those things to filter through, and clearly not all markets are feeling it in the same way. Now, what the impact is or what's driving this is really these increases to interest rates, which are massively increasing the cost of borrowing and the cost of owning property for individuals. That is pushing people out of the property market as well, because when interest rates are increasing, it has the effect of reducing the amount that people can borrow. It makes it harder to fund your mortgage payments, but the banks will actually lend you less money. So we can see that, like, one example that I was looking at is a family with a combined income of 200,000 before tax are able to borrow now around $1.1 million, which is $294,000 less than went before the RBA started raising interest rates. If the forecasts come into play and the cash rate increases to 3.8%, 3.85% as predicted, the that same family's borrowing capacity will fall to about $1.02 million, or a reduction of $394,000 in total borrowing power than before the rate rises started. So what that means is that we've got people that can borrow less money, which means that less people are going to be competing in the property market for certain properties, which has a downward impact on demand and therefore, less pressure on prices or maintaining prices or to stop prices going down. And then you've got the actual funding of the payments, because on a $1 million principal and interest loan, 25 years, that there's an extra $11,500 in interest costs, according to data based on the interest rate increases. For next year, if the cash rate rises to 3.85% as predicted, that the total repayments on that $1 million loan is about $58,000, which is an increase of nearly $34,000 a year. Now, a little while back, I did a piece on how much it actually costs to own an investment property, and I did it based on the interest rates at the time, which were around the 3% mark. What I found is that on $1 million property, without getting into all of the details, essentially after tax, the net cost of owning an investment property is about $8,000 a year, $8,114 actually. And when you factor in the fact that $1 million property, if it increases at the 150-year growth rate in the property market, 6.3%, it should grow by about $63,000 a year. If you're paying $8,000 to benefit by $63,000, you're still over $50,000 ahead. So it's, technically what we call a no-brainer in financial planning speak. But with the interest rate increases, and I was just looking at what the average mortgage interest rate is at the moment, and it was actually 4.4%, I think was the number that I was using as an average rate. There are lower rates, but there are also higher rates as well. What it did was it increased the total cost of that same $1 million property after tax to about $23,000 a year. So clearly it's almost tripled in terms of the actual holding costs of having an investment property. But if you relate that back to the potential property growth over the long term, the $1 million property should still be growing at $63,000 a year. So paying $23,000 to benefit by $63,000, those numbers still make a lot of sense. You're still better off to the tune of $40,000 every single year. So property does still make a lot of sense, but you do need to fund the payments. And so you will need to find a way to make that work. And that means that your planning is actually all important. So look, I suppose to this piece, like when the property market is likely to bottom, looking at the views of a bunch of experts and economists, that it's obviously there's some variation between what people think, but the majority is saying through 2023 is when we'll see the bottom of the current market. There's predictions ranging from as early as CoreLogic said that the first quarter of next year. JP Morgan have come out saying around the middle of next year. And what they're saying is the driver of this is the fact that the interest rate increases, which have been the main driver of the property market decline, that they're heavily front loaded. The banks have been really aggressive, or the RBA has been really aggressive in tightening their cycle. So it means that most of the pain and most of the decline in the property market values are being seen at the front end of the market. And because the rate rises are so aggressive, it means that they'll get them sort of like out of the way a little bit sooner, and then the property market should stabilize. Tim Lawless is the director of CoreLogic, who's basically one of the biggest property research and data providers, that he has said that doesn't expect housing prices or values to stabilize until the rates find a ceiling. So given that there's a moving target around inflation, it's a little bit unsure as to what that is. But he said it could be potentially as early as late this year or through the first quarter of next year. Although it's depends on who you speak to. Shane Oliver, who's the AMP chief economist, said that he thinks that potentially the decline could reaccelerate next year, particularly as some of these fixed rates come off expiry, which a lot of them are happening in June and December of next year. So that he's saying, lining up with some of the declines that we're seeing in economic conditions around the world, means that there could be more pain to come for property owners. Talking about, though, whether rate cuts are on the cards in the next couple of years, looking at the forecast from the bigger banks, we see that CBA is predicting 25 basis points cuts in August and November of next year. Westpac is predicting 4 interest rate cuts in 2024. ANZ is predicting a couple. NAB is saying that they think that interest rates will go down by 1.2% by mid-2024. And AMP is forecasting that the RBA will start cutting by the end of next year or early 2024. So there is some light at the end of the tunnel, but there's a bit of tunnel to get through, unfortunately, to get there by the sound. But no doubt, as you see from those numbers, that they do stack up when thinking long term. It just means that you're planning around property really crucial in the short term to make sure that you're not caught short and you get the results that you want. My last piece for this week is around the calls for tax cuts to the super tax concessions to help repair the budget. Really sad news, and it really disappoints me that that the government keeps tinkering with super to repair their budget. I think the government takes away from the confidence of Australians in the super system, which is not massively high to begin with, by talking about mucking around with the rules there. And instead of, in my view, focusing on things like this $100 billion annual void created by the NDIS, which is a very valid and important program, but an area where prices are really skyrocketing from what they're predicted, and thinking about how they can repair them, which should have more of an impact than mucking around with super tax concessions. Instead, they're choosing to take away from the people that have followed the rules that the government have set around super to try and prepare for their retirement. Now, you might be able to tell that this does grind my gears a little bit, because I'm dealing with people, and obviously the super tax concessions are fantastic. I know as a financial planner, when I look at the numbers, it makes a lot of sense. Super is never really going to be, for younger people in particular, your go-to investment strategy, but it shouldn't be, it's not going to be your first, but it also shouldn't be your last. So the tax rules are compelling, but people need confidence to actually follow them through. The government's talking about changing things like putting a cap on the total amount you can have in super and get concessions, or not allowing people to pass on tax to their dependents. All the measures which potentially are going to save, not a small amount of money, but also not an earth-shattering amount of money either. So the fact that they're doing this, taking away from people's confidence, to me, I think it's just bad, bad, bad. So hopefully they come to their senses and figure out other ways to get there, but it looks like there could be some tinkering to come. Guys, that's it from me for this week. I will catch you on the next one. Bye.